Imagine this. You've just moved into your dream home and somehow managed to get it just below the asking price. So it feels like a real bargain. And then your first mortgage repayment comes out. Rates are going up and sure, it stings a little, but you know you're paying off your home and making steps to owning your home completely. But then you log into your internet banking. You just paid $3,000 in your repayment to the bank and less than $500 went towards paying off your home loan. It doesn't feel great. With interest rates where they are today, you're going to be giving a lot of your money to the bank, and most of it isn't going to pay off your loan balance. In fact, for a $500,000 loan over 30 years, you're going to pay over $600,000 in interest. You've probably heard the tip. Just pay a little bit extra on your mortgage each month and it'll save you a ton. Sounds simple enough, right? But how much truth is there to this? And is it really a magic solution or just a band-aid? Today, we're deep diving into the world of mortgages, specifically looking at what happens if you commit to pay an extra $1,000 a month towards your loan repayment. Now, listen, I'm not going to be throwing just numbers at you. We're going to break it down step by step and look at the real impact that these extra payments are going to have and guide you on how to make an informed decision about your mortgage. Completely forget about those quick hacks. A video you might have seen about TikTok paying $1 a day to clear off the interest. It doesn't work. It's time for some real talk and how to tackle your money smartly and efficiently.
Welcome to the Buying Your First Home podcast, your personal guide through the Australian housing market. Here we tackle the big questions and the small details that come up when buying your first home. From financial prep to finding the right neighbourhood, we're here to ensure that you've got all the knowledge at your fingertips. So let's take the first step towards unlocking the door to your new home.
Let's start with the basics, understanding how mortgage repayments are structured. Your mortgage payment isn't just about paying back the loan. It's split into two payments, the principal and the interest. Paying off the principal means that you're paying off the loan balance, the amount you borrowed, whereas the interest goes straight to the banks to line their pockets. So how do these work together? When you establish your mortgage, your principal and interest combine to make up your monthly repayment. So if you've got a $500,000 loan, your monthly repayment will be $3,078. And at the start of the loan, you'll be spending most of that $3,078 on interest, not on the principal. As time goes on, you start paying off more of the principal, which produces interest costs. So more of your $3,078 repayment goes towards paying off your principal. After 5 years, 22% of your monthly repayments are going towards the principal. This is up from 15% in year one. Assuming the interest rate stayed the same, your monthly repayment remains the same, but you're paying less interest over time. By the time you hit year 19 on a 30-year loan, you're paying off more principal than interest. But yeah, those first few years can be pretty brutal. After 5 years, you'll have only paid $33,000 your principal and $151,000 in interest. And at the end of your 30-year loan term, you would have paid over $600,000 in interest to the bank. For the sake of simplicity here, we're assuming interest rates don't change. If the rates go up, you're going to be paying a higher repayment, but generally the proportions of interest to principal remain more or less the same. The good news is if rates go down, you can keep your payment the same and pay more towards your mortgage. So what can you do to pay off your loan faster so you don't have to pay more interest? So how much would an extra $1,000 a month impact your mortgage? As it turns out, quite a lot. Paying an extra $1,000 a month would shave 13.7 years off your mortgage. This would mean your loan would be fully repaid in 16 years, and that's going to save you over $300,000 in interest. So instead of paying back a total of $1.1 million to the bank, that's $500,000 in principal and $600,000 in interest, you're only paying back $800,000. The principal or the amount you borrowed remains the same, but you're knocking down that principal a lot quicker, which means there's less interest to pay. The extra $1,000 a month goes straight to the principal. So looking at your repayment, instead of just paying 15% of your principal in year one, you're paying 38% instead. And since there's compound interest involved, the effects are also compounded. At the 5-year mark, 50% of your repayment is going towards the principal. And I realize that money can be tight and the cost of living pressures are high. So with the current rates, an extra $1,000 might not be achievable. So let's look at a couple of other scenarios to give you a bit of an idea on what difference it makes. What if you pay just an extra $100 a month towards your mortgage? Even with an extra $100 a month, you're saving 2.5 years and over $60,000 in interest repayments. An extra $500 a month would save you 9.1 years and $212,000 in interest. So in other words, any extra money you put towards your home loan will save you a lot of money in the long run. So we've crunched the numbers and looked at the scenarios and seen the undeniable impact extra repayments can make on your mortgage. Even an extra little bit each month can make a big difference to the interest you pay over the life of the loan, not to mention cutting down the time it takes to pay off that loan. Finding that extra cash can be a challenge, with the cost of living being what it is, but the potential savings are really too big to ignore. Whether it's an extra $100, $500, or $1,000 each month, every little bit helps with chopping away that principal faster, saving you tens, if not hundreds of thousands of dollars. Now it's over to you. If you've got a home loan, take a moment to look at your budget and see what you might be able to squeeze out to put some extra dollars to that mortgage. Remember, this isn't just paying off your loan. It's about building your wealth, securing your future, and maybe even freeing up your finances for dreams that you've put on hold. My tip, start small. If $1,000 a month seems too big, don't sweat it. Begin with what you can afford. Even if it's just $100, every little bit can help. Number 2, use tools. Leverage online mortgage calculators like the repayment calculator on our website to see how much you can save by paying that little bit extra. Knowledge is power after all. Number 3, consult professionals. Refinancing your home loan to a lower rate is another great way to pay off your home loan faster. If you'd like a free home loan health check, get in touch with us at huntergalloway.com.au or call us on 1300 088 065 for a free assessment. Now, don't let this be another video you watch and forget. Take action, make a plan, and start paying off your mortgage faster. Your future self will thank you. And remember, we're here to provide you with the knowledge and tools you need to make your financial decisions. So hit that subscribe button, share this with friends and family that you think that can benefit, or drop us a line at huntergalloway.com.au. We're the home for home buyers across Australia. Until next time, see ya.